Hello viewers, welcome to my channel. I'm Hasham Khan. Now I'm going to start the next topic in income tax 1, that is income from house property. Already I have completed two main topics on income tax 1, that is introduction to income tax, and secondly income from salary. The next chapter, income from house property. Under Introduction to Income Tax Act 1961, I have explained the complete provisions regarding the taxability of an individual. What are the provisions that will apply in order to tax an individual's income? So I have explained in detail the concepts, the basic concepts used in Income Tax Act. I have explained you about residential status, incidence of tax, and incomes which are completely exempted from tax. That theoretical part is very, very important because the succeeding videos, the succeeding lectures depends on those provisions. So theory is very, very important. So until and unless you watch the theory with full concentration, with full focus, with full interest, you cannot be able to understand the problems. Problems are very easy to solve it. The only thing is you must remember the provisions. Secondly, income from salary. So many videos I have given on computing the income from salary according to the provisions of Income Tax Act. Almost 10 main problems, comprehensive problems I have solved on computing the income from salary. So many provisions. So hope my regular viewers have already watched those videos, got a good command on the subject of this income tax by watching my videos. So if you are new to my channel, if you have not watched the earlier videos, I suggest you to go to the playlist of my channel. Select the subject Income Tax 1 for the assessment year 2021. Select the topic Introduction. Select the topic Income from Salary. Watch those videos. Then only you come to this video. You can be able to get a good grasp. Now I'm going to start this topic of income from house property. First of all, when an income is taxable under the head income from house property. If an individual, if a person receives a rent from the property which is owned by that individual, by that person, that rent is taxable under the head income from house property. A person may earn income from property in two ways. By letting out the property, getting the rent, that is taxable, income from house property. Similarly, at the time of sale of the property, when the person is selling the property, he may get some gain. That income arising on the sale of property, that is taxable under the income from capital gain. Not here. Separate head is there. Income from capital gain. In that head, the gain arising on the transfer of capital asset, on the transfer of property, that will be taken. But right now, it is the income in the form of rent received, that is taxable under that income from house property. Now, three conditions have been given by Income Tax Act when we have to treat the income as income from house property. First condition is the property, the house building should be structured permanently. It's a permanent structure on the land, then only we can treat it as income from house property. Simply walls are there or open land is there, that in rent will not be treated as income from house property. There should be a roof, there should be walls, there should be a door. If doors, roof, wall, complete permanent structure is there, then only the rent received is taxable under the income from house property. Secondly, the person should be the owner of the property. If the person is receiving the rent but not the owner, that means non-owner is receiving the rent. This will happen in case of subletting. So rent from subletting is taxable under income from other sources, not under income from house property. The person should be the owner of the property. Sometimes deemed owner. Third condition is deemed owner. Sometimes the owner is not the genuine owner, real owner. He will be treated as a deemed owner and the income is taxable under the income from house property. When this deemed owner will arise, when a person transfers the property to spouse without any consideration. Mr. X has transferred the property in the name of Mrs. X without any consideration. Then actually the ownership is in the hands of Mrs. X. But Income Tax Act will tax the income in the hands of Mr. X. Because he has transferred the property to Mrs. X without any consideration, he will be known as deemed owner and he will be taxed. Similarly, in case of member of a cooperative society. In a cooperative society, a person, a member, will get allotment of the house. He has let out the house, but the ownership of the house is in the hands of the society till the last payment, last installment. Till that time, the ownership is in the hands of the society. But SSC, the person will be treated as deemed owner. And if he has earned any income of that property, he is liable to pay tax. So these three are the conditions. Then only the income will be treated as income from house property. Now, use of house by the owner of the building. A person who is the owner of the building can utilize the building under three methods. He can use the building under three methods. What are the three methods a owner of a building can utilize it? First one, let out the house. Let out the house. The first most commonly used method of using the property is letting out the house. In that case, the taxable income and expense incurred are allowed as deduction. Income Tax Act says if a person has let out his property and getting the rent, that rent is taxable under that income from house property, and some expenses will be allowed because some expenditure is incurred in order to earn the income. Any expenditure incurred in order to earn the income is allowed as deduction. So next one is for running own business or profession. Sometimes a person will run his own business or own profession in his own building. In that case, Income Tax Act says the income from house property will be nil, because he is using the property for running his own business or for running his own profession. The income of such house will be nil, and the expenditure incurred on that house will be treated as business expenditure. It will be treated as a business expenditure or professional expenses. Next one, for own residential purpose. A person who is owning the property can utilize the house for his own residential purpose. In that case, the income of that house will be treated as nil. Only some few expenditure will be allowed as deduction. That will do it while doing the problem. I'll explain you in detail. So if the house is used for self-occupation, self-residence, annual value is nil. No deductions are allowed except one deduction. What is that? I'll explain you later. So in these three methods, a person can use the house property. He can let out, he can use for running his own business or profession, or he will use it for his own self-occupation. Now, method of computing income from house property. How to calculate the income from house property? For this purpose, we divide the houses into two categories. The first is let out house. Second one is self-occupied house. So you have to remember all these provisions, then only you can be able to understand while solving the problem. So I told you in the earlier videos also, theory is very, very important. You must have the interest, you must have the patience, you must have the concentration to watch these videos. Next, let out house. The let out houses are again divided into two categories. Those are the houses which are governed by Rent Control Act and the houses which are not covered by Rent Control Act. One act is there, that act is known as Rent Control Act. To some areas, this Rent Control Act is applied, whereas other areas it is not applied. So while doing the problem, we have to see whether the house is covered by Rent Control Act or the let out house is not covered by Rent Control Act. That you have to see. Next, basis of charge. Basis of charge means rent will not be calculated on the actual rent received. See, Income Tax Act says income is taxable on that income which is earned by the SSC, which is received by the SSC. Which is received by the SSC. On that income only tax will be charged. For example, salary. If a person earns the salary, how much salary he has received, on that basis income tax is charged on income from salary. But in income from house property, it is different one. It is different one. The basis of charge is the earning capacity of the building, not the actual rent received. The earning capacity of the property is the criteria for taxing the income from house property, not on the actual rent received. Example, if a property is there, suppose I am having a property which is let out. I have let out this house property to my relative. for a nominal rent of 5,000 rupees per month. 5,000 rupees per month I have let out to my relative, because he is my relative. At concessional rate I have given 5,000 rupees per month. Whereas the other properties in that locality, in that area, is 10,000 rupees per month. The actual rental value in that area is 10,000, but I am charging only 5,000. Income Tax Act says your taxability will not be on 5,000. You have to pay the tax on 10,000. So 10,000 per month into 12, 1,20,000. The total rental value of the property per annum is 1,20,000, whereas I am actually receiving only 60,000. 5,000 into 12, 60,000 I am getting. The Income Tax Act will not charge the tax on actual rent received, but the rental value of that property. What is the earning capacity of that building? That is called rental value. So this is the basis of charge. Now annual value. The income from house property will be calculated on the annual value of the property. Annual value means the value, the reasonable value which a property will earn in that particular area. What is the reasonable value? What is the reasonable rent that property will earn in that area? That is called annual value. So first of all, we require annual value for computing the income from house property. So how to compute the annual value? By considering four factors, four values. What are the four values? Municipal rental value, it is called MRV. Then actual rental value, it is called ARV. Fair rental value, FRV. And standard rental value, SRV. By considering these four values, four factors, we calculate the annual value. So what is the municipal rental value? The rental value which is fixed by the municipal authorities. The rental value which is fixed by the municipal authorities, local authorities. Because Indian Constitution has given the right to the local authorities to input the tax, property tax. So municipal authorities will fix what is the rental value for each area-wise houses, each area properties. So the value fixed by the municipal authorities is called municipal rental value. Second, actual rental value. The rent actually charged by the owner, by the landlord to the tenant. How much tenant is paying the rent, that is called actual rent. Fair rental value. The rental value which applies to that area, particular area. That means what is the rental value of that building in that particular area. Because similar area will fetch the similar rent. For example, a particular area is there. One flat is let out for rupees 20,000 per month. 20,000 per month is the rental value of one flat. The other flat will also fetch the same rental value because both the flats are in the same building, same area. So fair rental value is the rental value of other similar accommodation in the same locality. Standard rental value. The standard rental value is the rent fixed by the Rent Control Act, rent controller. So, some areas are there which are covered by Rent Control Act. In that Rent Control Act, one person rent controller is there. So he will fix the rent in that area. That rent fixed by the rent controller is called standard rental value. But standard rental value will not always be there. Only few areas are there where Rent Control Act will apply. There we will have standard rent. Other areas where we don't have Rent Control Act, we don't have standard rent. So next, procedure of computing income from house property. Compared to income from salary, computation of income from house property is simple. Less provisions are there. Easily we can find out income from house property because the provisions are few compared to other heads. So what is the procedure of computing income from house property? First of all, gross annual value. Commonly it is called GAV. First you need to calculate GAV in working note. That is the only main complication in this computation. GAV, gross annual value, you have to calculate in working note. Then after taking GAV, deduct municipal taxes or local taxes. Municipal taxes or local taxes, if it is there, deduct it. You will get net annual value, NAV. From net annual value, two deductions are given under section 24. First is standard deduction under section 24A. and second, interest on loan under section 24B. Deduct these two deductions, 24A, 24B. Take it in the outer column, then income from house property. This is a simple procedure of computing income from house property. Now one by one deduction. Deduction under section 24 are only two. That is standard deduction 24A, interest on loan 24B. First 24A. It's a compulsory statutory deduction. So every person who is having income from house property, he will get standard deduction, which is fixed at a flat rate of 30% on NAV, net annual value. Whatever net annual value NAV you get on that 30%, you calculate as standard deduction or statutory deduction. That's all. Next, 24B, interest on loan. Sometimes a person will take a loan to purchase the house or to construct the house. In that case, the interest paid on loan will be allowed as deduction under section 24B. Now, you have to be careful regarding this. Particularly, students will commit the mistake in 2 points. First, in calculating GAV, second, in calculating interest on loan. So, concentrate here. Interest on loan taken to purchase or construct or repair or renovate or reconstruct. Remember these 5 points. That means loan taken for the purpose of purchasing the house, constructing the house, repairing the house, renovating the house, or reconstructing the house. Only for these 5 purposes is loan. If loan is taken, interest is paid, then it will be allowed as deduction. Apart from these 5 purposes, if for any other purpose loan is taken, not allowed as deduction. Then if interest is paid in India, actual interest paid. If loan is taken in India and interest is paid in India, then actual interest paid will be allowed as deduction. If loan is taken from outside India, then Income Tax Act says TDS should be deducted. If TDS is not deducted, interest on loan will not be allowed as deduction. Next, interest on loan is allowed on due basis also. It is not compulsory that it is paid. Even if it is due, due is also allowed. For example, for 1 year, interest amount comes to 1 lakh rupees. 1 lakh rupees is the interest payable. Out of 1 lakh, only 80,000 is paid. 20,000 is due, outstanding, not paid. Income Tax Act says complete 1 lakh rupees allowed as deduction. Whatever you have paid and whatever it is due, the complete will be allowed. Third, if interest paid for earlier period is not claimed as deduction, then the same cannot be claimed in the current year. If on account of any reason, if earlier interest on loan was not claimed, it cannot be claimed right now. Next one, interest on loan taken to purchase or acquire the property or construct the house, interest paid for a period prior to the purchase or construct will be allowed in deduction in 5 annual equal installments commencing from the previous year in which the house construction is completed. Example, if a person has taken a loan for constructing the house, for example, a loan has been taken for rupees 20 lakh. 20 lakh rupees loan is taken to construct the house. After taking the loan, construction started, but construction was completed in 5 years. In 5 years, the construction was completed. Now, loan taken was 20 lakh. The interest paid before construction, before completion of construction, will be allowed as in 5 equal installment after completion of construction. After completion of construction. Construction complete करने से पहले, suppose 1 lakh rupees interest on loan was paid. So 1 lakh divided by 5, 20,000. So every year 20,000 interest on loan will be allowed as deduction from the year from which the construction was completed. After completing construction in 5 years, that prior period interest on loan will be allowed as deduction. I'll discuss more on this point in the problems. Interest on interest or penal interest is not allowed. That means if penalty is applied, penalty interest is not allowed as deduction. Last one, brokerage or commission paid or expense incurred to raise the loan is not allowed as deduction. Sometimes a broker is appointed, a commission agent is appointed to grant the loan, to sanction the loan. The brokerage paid, commission paid to get the loan is not allowed as deduction. These are the points regarding interest on loan. Now, composite rent. Sometimes in the problem, the owner of the property has let out the building for a composite rent Composite rent means rent of the building plus the rental value of other facilities provided by the landlord to the tenant. So apart from building, some facilities are given by the owner to the tenants. These facilities the owner will charge. For example, security guard is provided, lift maintenance is incurred, water charges, electricity charges, gas charges. These are the separate facilities provided by the landlord to the tenant. For these services, some charges are made along with rent. So only house rent is 20,000. 30,000 is the composite rent. 10,000 extra it is charged for facilities provided. So Income Tax Act says we have to segregate. We have to segregate the rent of the building and the rent of the services provided, charges for the services provided. So the rent of the building is taxable under the head income from house property, whereas charges made for facilities provided, that is taxable under income from other sources. These are the points we have discussed so far. Up to composite rent we have completed. Now the next topic is unrealized rent. Last topic we have completed composite rent. Now unrealized rent, the amount of rent that the owner is unable to receive from the tenant during the previous year if the landlord does not receive the rent from the tenant, that is called unrealized rent. Then unrealized rent should be deducted from the rent of the actual rental value of the whole year. So how to calculate the ARV? ARV will be calculated rent per month into 12. That means the actual rental value for the whole year minus unrealized rent. So unrealized rent should be deducted from the actual rental value of 1 year. Then note, outstanding rent should not be treated as unrealized rent. There is difference in the meaning of outstanding rent and unrealized rent. Outstanding rent means rent due but not received. The outstanding rent should not be treated as unrealized rent. If it is specifically given unrealized rent, then it should be deducted. The next one is annual value of self-occupied house. So far we have discussed the provision regarding let out house. Now we'll discuss the provision regarding self-occupied house. And a house which is used for self-occupancy or self-residence of the SSC. If the owner occupies the house for his or her residential purpose, then the annual value of such house will be taken as nil. The annual value of a self-occupied house should be taken as nil. That is, income from such house is fully exempted from tax. If an SSC has not let out the house, not derived any benefit from the house, but the house is used for self-residence, in that case, the Income Tax Act says the annual value will be nil. The annual value will be nil. That means it is exempted from tax. Deductions for self-occupied house. No deductions are allowed under section 624 except interest paid on money borrowed for the purpose of purchase or construction or for repair, reconstruction of the house. That means for this self-occupied house, deduction under section 24 will not be allowed except one deduction, that is interest on loan taken to purchase the house, to construct the house, to repair the house or to reconstruct the house. For this purpose, if loan is taken and interest is paid, then that interest will be allowed. So the annual value will be nil. Then deduction will be allowed. That means we'll get loss from self-occupied house because the income is nil, but expenditure is there, interest on loan. Apart from that, standard deduction will not be allowed. Now, model 1. So this self-occupied house, we have different models. First model is if the house is purchased or constructed and the loan is taken before 1/4/1999. Regarding the provisions of interest on loan, for self-occupied house, interest on loan will be allowed as deduction depending on different models. The first model, if the house is purchased or constructed and the loan is taken before 1st April 1999. So you have to see whether the loan is taken before or after. If the loan is taken before 1/4/1999 and loan is taken for the purpose of purchasing or construction of house, the deduction is least of the following two amounts: actual interest paid or fixed ceiling given by Income Tax Act is 30,000. Whichever is least in these two amount will be allowed as deduction if the loan is taken before 1/4/1999 for the purpose of purchase or construction of house. Second model, if the house is purchased or constructed and the loan is taken after 1/4/1999, that condition, actual interest paid or 30,000, whichever is less, will be applied if the loan is taken before 1/4/99. If the loan is taken after 1/4/99, if the SSA satisfies the following three conditions, then the deduction will be given up to 2 lakh. So instead of 30,000, the maximum ceiling will be up to 2 lakh if the following three conditions are satisfied and the loan is taken after 1/4/1999. What are the three conditions? The first, the loan is taken on or after 1/4/1999 either for construction or for purchasing the house. Only two conditions are given. The loan must be taken only for purchasing or for constructing the house, and the loan is taken after 1/4/1999. First condition. Second condition, the construction or purchase process should be completed within 5 years from the end of the financial year in which the loan is taken. The construction process or the purchasing process should be completed within 5 years from the financial year in which the loan is taken. From the end of the financial year in which the loan is taken. From the end of the financial year, next 5 years. Within 5 years, the purchase process or construction process should be completed. Next, the lending person or institution has given a certificate giving the required details. That means the person or the institution which has given the loan should give a certificate regarding the loan amount, balance outstanding, interest payment. All these details should be given by the lending institution. If these three conditions are satisfied, then the maximum limit will be 2 lakh rupees. If any one of the condition is not satisfied, then that limit will not be 2 lakh, the limit will be 30,000 only. That's it. Now model 3. The third model says if the loan is taken for repair, renovation or reconstruction either before or after 1/4/1999, this 2 lakh rupees limit is given only for purchasing the house or constructing the house. If the loan is taken for the purpose of repair, renovation or reconstruction purpose, then whether the loan is taken before 1/4/1999 or after 1/4/1999, least of the following two. Actual interest paid or 30,000 limit. 2 lakh limit will not be applied. For loan taken for repair, reconstruction, renovation, the limit is only 30,000 whether the loan is taken before or after 1/4/1999. That's it. So these are the provisions regarding self-occupied house. Now, next point. If a person occupies 2 or more than 2 houses as self-occupied throughout the previous year, sometimes an SSC is owning 2 houses or more than 2 houses for self-occupied purpose. Sometimes he is living in first house, sometimes he is living in second house. Both the houses he is using for self-occupied house. He has not let out. The Income Tax Act says any one of the house he can treat it as self-occupied, and the other house he has to treat it as deemed to be let out. Not actually let out, but deemed to be let out. The SSC has to decide which house should be treated as self-occupied house so that the other house will be treated as a deemed to be let out house, and we have to calculate the income of that deemed to be let out house as if it is let out. We have to treat as if it is let out and find out what is the income from house property. For example, A and B, 2 houses are there, house A, house B. The SSC has to decide which house he has to treat it as self-occupied. If he has treated A house as self-occupied house, B house will be treated as deemed to be let out. If he has chosen B house as self-occupied house, A has to be treated as deemed to be let out house. And we have to compute the income as if it is let out. Then next point, self-occupied house. During the previous year, part of the period is let out and the part of the period is self-occupied. During the 12-month period, a part of the period, let it be 4 months. First 4 months of the previous year, he has treated it as self-occupied, and the remaining 8 months he has let out. So in the previous year of 12 months, 4 months self-occupied, 8 months let out. So how to compute the income from that house? During the previous year, part of the period is let out and part of the period is self-occupied. Under this situation, the period of self-occupancy is to be ignored completely. The period of self-occupancy of 4 months should be completely ignored. That is, income from house property is to be calculated as if the house is let out for the whole year. We have to assume that the house is let out for the whole year, 12 months, and we have to compute the income from house property. That is, for the self-occupied period, income is not to be computed. For first 4 months of self-occupancy, the income should not be completed. Municipal taxes paid and interest on loan is to be deducted fully. For the whole year, municipal taxes and interest on loan will be deducted. Now, if the part of the house is self-occupied and remaining part is let out, in such situation, 2 income statements should be prepared. For example, a big building is there. Half of the building is self-occupied, remaining half of the building is let out. In that case, 2 different statements have to be prepared. The first statement, computation of income of self-occupied house, and the other statement, computation of income of let out house. Now the common expenditure, just like municipal taxes, have to be divided between these 2 houses, and other expenses like interest on loan will be divided in these 2 houses according to the instruction given in the problem. If instruction are not given, we have to see the area. According to area wise, common expenditure will be divided between self-occupied house and let out house. Last thing is self-occupied house vacant due to employment or business. A person, an SSC, has kept vacant throughout the year his self-occupied house because due to change in employment place or because of change in business situation. The person has moved from one place to another place. The house remained vacant throughout the year. He has not let out. He has kept it vacant, and he has, on account of job, he has moved from one place to another place. The annual value of such vacant house will be taken as nil. No deduction under section 24 will be allowed except deduction under section 24B. As usual, no deduction. Annual value will be taken as nil. No deduction will be allowed under section 24 except one deduction, that is 24B, interest on loan taken to purchase the house or construct the house, which is least of the following: actual interest paid or fixed amount, either 30,000 or 2 lakh. If the loan is taken before 1/4/1999, 30,000. If the loan is taken after 1/4/1999, 2 lakh. So whichever is applicable, that ceiling amount we will take. That's all. So this is the completion of the theoretical part of income from house property. I have not explained in detail. Briefly, I have given the explanation. Every now and then, while doing the problem, we come across new point, special points. I'll discuss the provision of income tax at that point. Because if I explain all these provisions in detail, that video will become large, will become huge. Those students may not find it easily understandable. So, brief point I have explained here. The detailed point I'll explain you while doing the problems. So, this is the end of the theoretical part of computation of income from house property. So, if you are satisfied with my lecture, if you think that these lectures are increasing your knowledge, give a like to the video. Give your suggestions, your comments on these videos. Share it in your group, in your friend circle, so that more students can watch these videos and enhance the knowledge, pass the examination, have the confidence on the subject. And lastly, don't forget to subscribe my channel. In the next video, I'll start the problems on computation of income from house property.